Hey guys, welcome to this week's Money and Investing Show. This is part one of our market outlook, review and forecast for 2023. This week we are going to be looking at what's happened through 22 and more importantly where we see some of the key risks for markets going forward. Part two, the podcast that will follow next week, will specifically get into the trading tactics and strategies that we're using to exploit this. Hope you enjoy the show. As always, take plenty of notes, but most importantly, make sure you take plenty of action. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, joined by my offsider and co-host, Mitchell Laurential.
Thank you for having me on the show, Mr. Baxter, and always being forward-thinking and young and hungry. What I want to get today is your 2023 economic outlook. It's a very big question. I know we've been briefing our clients on this a hell of a lot leading into this Christmas period, but I want to hear it straight from the horse's mouth, my friend.
Look, it's a mammoth one, isn't it? And I guess, as a preface for this, I think one of the biggest pieces of advice I'd give anyone when it comes to trading and investing is that, a lot of people are under the misnomer that trading is about guessing what's going to happen. I think success in markets isn't about trying to predict or forecast or guess what's going to happen. It's about responding to what's happening. It gives you a high level of certainty and enables you to make, I think, better quality decisions. But I think having an outlook and a view is a crucial starting point to any kind of investment strategy. Whatever it is that you do, you've got to have a view on what's going on and I guess a level of validity to that view by looking at the statistics, but also looking out the window at what's actually going on anecdotally.
Absolutely. And we know that your bread and butter is fundamental analysis, being a news addict, and that's certainly rubbing off on me. So probably a good place to start if we just jump into this, AB, for 2023. One category would have to be inflation and interest rates. Where do you see those?
Look, I think going into 23, and firstly, let's just take a look in the rearview mirror at 2022. I mean, each year that goes by, you kind of go, okay, that was an interesting one, and that's kind of what's given me the fuel to be in markets, I think, for 30 plus years now, because each year is as unique as the next. I don't think you're going to see another year like we had last year.
It's weird.
It's for so many reasons. I think if you look back since the start of history, it's the first time ever, for example, that you've had both equities and bonds fall in value by more than 10%. Never happened in a single year previously since records started. So it's definitely an outlier. And one, I think, of the themes through the year very obviously is inflation. We've gone from an environment where inflation has been largely under control and within most central banks' range of expectations. And this year it's just gone through the roof. And I guess it's a legacy from the massive government stimulation that we saw around the world through the pandemic, and that additional cash that's been poured into markets and into economies has come home to roost now with rampant inflation, which is at a 40-year high.
You think about some of the figures we've seen, nearly 10% in the US, over 10% in the UK, and we're heading towards 8% according to our RBA governor in the near term. It's pretty crazy, right?
It is, and again, it's the first time for 40 years that you've seen really anything like this, and so for many people, many investors and participants in markets and a large tract of society, they've never seen it and don't really know that inflation is not just simply an economics term. It's something that has genuine fangs. And we've talked about this multiple times over the last year or so of the rising cost of living, inflation to all intents and purposes, and we can look at some of the drivers in there in just a few moments, but it's a very real pain for people filling up your car with gas, filling the grocery trolley with food, paying for your electricity and energy bills, paying for your private health cover, whatever it may be, has all got, significantly more expensive flying, which you're about to do. And as we've been doing plenty of over the last few weeks is another one that's really surged. And inflation comes around in two areas. There are two types. There's cost push and there's demand pull. Looking at those separately because they're both quite different. Cost push is where the cost of producing something. So let's say you're in manufacturing, so your energy costs are higher, fuel costs are higher, labor costs are higher, the raw material input costs are higher. You then pass that price rise on to the consumer, pushing up in a price. That's cost push.
Gotcha.
Demand pull is where there's just this thirst for goods and services that are being sucked out of the economy, and it becomes an auction system, if you will. A very good example of that would be the car market right now, where there's still a wait list because of disruptions to the supply chain. And so, it's very, very hard to negotiate on buying a car. You're competing with somebody else for a fairly finite amount of resource right now. So that's an example of demand pull. So they're quite different things. But you're right, we've seen inflation now head up into double-digit territory in the UK and not far far off it for us in the US, and it is a massive problem. So central banks have come out, and the major tool that's used on a headline basis to try and tackle inflation is, of course, interest rates, and that's had a massive impact, obviously, on mortgage servicing for people, and it's really starting to bite and show its teeth now.
So if we had to look forward, AB, into 2023, let's split them up and say Aussie and US. What are your inflation expectations for each market respectively?
Yeah, I don't think we're tapped out here, and I think there's an enormous distinction between the US and Australia, and that if we look at their central banks, and we've talked about this plenty of times last year, I think the way that Jerome Powell, the chair of the Fed, has handled his obligation as chair of the central bank has been very transparent with markets and given really strong qualitative backing up of the decision making that they've made. So he comes like, we're going to take an aggressive stance with interest rates. That means 0.75. We're starting to see new data, which is prompting us to soften our view, means 0.5 in the current terms. And so markets are able to respond very well. And it's important for people to acknowledge that markets hate uncertainty. They love that transparency of communication. So from a US perspective, I think, going into the early part of this year, we're probably going to see a significant slowdown in those interest rate rises. I think there's possibly one or two left in the tank, as we really do make sure that the sort of embers of the flames of inflation are properly stamped out.
So maybe a February, maybe 50 basis point rate hike, and then maybe something in March?
Yeah, look, on the back of December's, I think another 50 in February, no meeting in January, of course. And then on the back of that, I think we'll start to see that decline quite aggressively, based on, of course, the data points. If we see CPI rear its head again, then I don't think there's any question that they'll ramp it back up to 0.75 again as is needed. But if we do see that inflation rate start to slow down, I don't think they're going to take their foot off the gas. I think they'll still continue to tighten things, but the aggression level of tightening will wane away to the point where I think we'll see peak interest rates before the middle of the year, and we'll start to see them stabilize in the back end of the year, I suspect, in the US. Over here,
what about here? Yeah, because we've been a bit all over the shop, right? We had 25 basis points, we had 50, now we're back to 25, even though our expectations on inflation are higher.
Yeah, look, I mean, our central bank have done an appalling job, led by the chief incompetent, the chair of it, being Dr. Philip Lowe. My pet last year was, of course, bagging him, and I don't think that's really changed. Their ability to communicate their intention to markets has been really opaque instead of really clear, and for whatever reason, who knows, because the clearer it is, the more structurally sound and orderly markets can behave, which is also part of their mandate, of course. So I think they're grasping at straws at the moment. They've got this very, very fine balance to try and tread between curbing inflation and sending us into a recession. I don't think the US is going to go into a recession. I think it's going to be barely any growth. So it's a semantic point, whether it's 0.2% growth or a recession, it's going to feel the same. It's going to be slower. Here in Australia, I think there is a far higher probability of us going into recession, principally on the back of a weaker property market, which I'm sure we'll talk about. But I don't think we're done with rate tightening here. I think there's a fair way to go. And it's quite unpalatable every time they have to make an announcement that they're moving rates up, that they've failed on their promise to hold them steady until 2024. And that's why I think they've just been a bit touchy-feely about how they've gone about doing it, and that's not provided a level of confidence in markets. Markets respond to confidence and clarity, and that's something that's very, very sadly lacking from the RBA. So I think we're in for at least 2 or 3 more rate rises, albeit some of them could be smaller at the sort of lower end, going into next year, or this year, should I say. And again, I wouldn't be surprised to see them sort of peak out around mid-year.
So kind of fleshing that out just a little bit more, AB. Interesting point you made earlier today, and we'll kick in the can around, is the difference between homeowners for the most part in the US versus Australia. So most people, correct me if I'm wrong, in the US are on 30-year fixed mortgages locked in at a pretty low rate.
Yep.
Here in Australia, if you're on a variable rate, you've been cleaned up. I look at my investment property, it's probably an extra $2,000 a month, I reckon, just in interest repayments that it's costing me. So
mere pennies for a man of your means.
Learnt well from you, right? So very different situations. On that basis, do you think that the Aussie property market will struggle a lot more than that of the US?
Oh, very much so. I mean, if we dive specifically into property now, you're right. That the biggest lesson I think the US took out of the GFC, which ultimately kind of started there, and was a major drag. In Australia, I think many people really failed to grasp the significance of the GFC because the Australian economy didn't really suffer. We had a mining boom simultaneously. Our relationship with China at the time pulled us through, and so really, whilst things were a little bit gnarly for a reasonably short period of time, and I don't wish to demean the significance of the GFC, but the Aussie economy fared very well because of that relationship with the miners, with China and iron ore. In the US, they didn't have that. And when you get a big setback, I think it prompts you, it's kind of punch on the nose, you taste your own blood, and it prompts you to sort of really think about what actions you've been taken. And in the US, the mortgage industry was shocking up until that point in time with all of the various toxic loans that have been put together by various lenders over that good time economic environment. And the big lesson I think the US took was that you need to decrease that risk. So you've had a significantly higher standard of lending. You've also, given how strong the US property market has been, most investors or owners there for that matter have got quite a chunk of equity in a property now. And then thirdly, the big significant point as you raise is that most people are on a 30-year fix. So if you fixed your mortgage at 2% or 3% for 30 years.
Happy days.
It doesn't matter what happens with interest rates, your monthly mortgage repayments are stable. And that's a huge takeaway point from the GFC. And so what we're seeing there, I think there's going to be a slowdown in housing activity. And I think there will be some weakness in property prices insofar as you're not getting people trading in the property market now, because if you move from one to another, you've got to refinance, and you've gone from a 30-year fixed at 2 and a bit to a 30-year fixed at 7 and a bit is a material consideration in terms of moving. So you go, look, we could probably stick here for a little bit longer, let things settle down, and then consider things next year. So that turnover in activity is a bit softer, and by its very nature, because you don't have buyers chasing the next property, you get a bit more of an anemic, if not slightly weaker market. So, you might see a little bit of a drop, 5-6% in prices there, but nothing to the forced selling levels that we saw post GFC. Now, the other impact of that is on new home starts, new building, because activity is lower. That's an area that's suffered this year, and I think will continue to, as it has to grapple with the uncertainty as we do of higher labour costs, higher material prices, and much higher cost of funding. And so those housing start statistics that we've seen, albeit November was a bit of an aberration, that number was a bit higher than people were expecting, is likely to show a weaker property market from a new house start. But I think residential property by and large is going to hold up quite strong there. Here in Australia, to give a bit of a contrast, that's a really different story. And there are so many borrowers out there, and I really feel for them, given the misleading promise that they've based their borrowing decisions on in some cases, where that pain of higher interest rates is really starting to bite. And I think we're going to see a more significant structural decline in property prices in Australia on the back of that. We've got a very skewed market where investors have been able to borrow at very low rates and acquire a lot of investment property, which impacts on the rental market, also impacts on the ability of first home buyers to get in there. And again, the regulator, be that the RBA or APRA, have kind of been asleep at the wheel in terms of the structural reforms needed in the Australian property market to shore it up. And I don't want to say this as someone that's also pretty heavily invested in property, but this might be our taste of what we missed during the GFC of that weakness. We had a fair lick down in the property market here, and we might be revisiting 20 or so % from highs would be a reasonable expectation, which is a touch more than what some of the economists have talked about. But those economists weren't also forecasting in interest rate rises that we've seen. And as you mentioned, if it's costing you a couple of grand more a month to service your mortgage, you've really got nothing more to show for it. And you do have to find that couple of $1,000s a month from somewhere. So that means other forms of spending has to slow down, and that will have a knock-on effect, of course, on the economy. Yeah,
it's a tough one, which could obviously represent an opportunity next year as well if you do see that play out, which we might cover in a part 2, by the way.
I'm sure we can.
So jumping in more into the consumer now, AB, what do you expect in the jobs market for both US and Aussie?
I think a slowdown in the jobs market is likely. I mean, we've seen a really rampant labour market. We've seen big wage pressure, and it's really hard to sit here and say this, but it's something that needs to be said, and that's that pay rises aren't the answer. Because if you get a 6 or 7% pay rise, all that does is add another 6 or 7% into the spending pot, which is driving prices higher, demand pull inflation once again. And so trying to chase inflation with higher pay awards is a strategy that was, I guess, demonstrably failed during the 1970s in the UK, and will no doubt fail again here. You can't keep up with inflation with pay rises. It's as simple as that. And I think, also the labour reforms that we're seeing in Australia under the Albanese government, it's just exactly the wrong policy at exactly the wrong time for all the wrong reasons. You should, and yet the Treasurer's got the audacity to say companies need to return to making profit. But if you're getting bashed around the head with higher labour costs, collective bargaining, dealing with unions, and everything else that goes alongside it, it's pretty hard to turn a dollar as a business, because during the good times everyone wants to participate in the upside, and when times are tough they want to be looked after first, and that comes at the expense of the overall profitability of the business,
which we covered in a podcast too. Small Business Strain.
So I think to that point, I think we're going to see a weakening employment market in the US. Obviously, you've got a ready supply of illegal labour hopping over the fence, or lack of fence, every 5 minutes at the moment too. So there's always a pool of cheap labour in the US with the way that that southern border is policed right now, and that will go some way towards sort of softening some of the pressure in the labour market. And I think as we move into a slower economy, I think you'll also start to see, as we've already seen in the tech sector, a lot of jobs being shed, and I think we can quite readily expect to see exactly the same thing happening here in Australia too.
All right. Well, it's a bit of a dire outlook when you think about it, and we hate being the prophets of doom, but these are just the hard facts based on data. What about the currency market, AB? US dollar's been pretty strong this year.
Look, it has. US dollars, put on about 10% against most of the majors, probably a touch more than that, 20% actually against most of the majors.
20% at its highs, at least,
over most of the majors, and part of that is because of the aggressive nature that the US have raised interest rates. Higher interest rates, stronger currency. Pretty linear relationship. But now that the US is sort of reaching that peak, or very close to its peak in terms of interest rates, we're likely to see other countries around the world probably catch up a little bit in terms of, if you take sterling or cable, dollar sterling as it's known, as an example, the UK government through, the Liz Truss mini budget, is shot itself in the foot. But as they move interest rates higher in an effort to rein in their rampant inflation, the pound has to gain some strength, which it will against the US dollar. And a strong US dollar has been quite good for America insofar as it's prevented them importing inflation from other higher inflation environments. But I think you're going to start to see some catch-up value, and we'll get onto this, I think, when we talk about opportunity later on. I think the Aussie dollar is likely to be a beneficiary in that relationship, which, again, if you look at sort of 66 against the US, that's a pretty punchy number when it was 76 not that long ago. So it makes it pretty expensive to do much over there. I think the US is likely to tap out a little bit, and we're going to see some of the other countries that have got tightening interest rates certainly catch up and enjoy a little bit more strength in their currency.
There's a lot to digest there, and if I sort of recap what we've spoken about just before we move on, there's obviously potentially weaker jobs market, property market, inflation coming down lower in the US in particular. What if we tie all of this in, AB? What does this mean for businesses in the stock market? Because we do have an earnings season coming up in January, early Feb. What do you think we could see there?
Look, I think earnings are in for a pretty tough time. I think if I had a criticism of our performance last year, I think our view has been right, and there's no ego in this. I think our view was right, but our timing was out by maybe a quarter or so in terms of we were expecting to see the pain come in the earnings. And in all fairness, that's testimony to how strong so many of these US companies have been, and the resilience that they've really demonstrated, that they've weathered the storm of all of this nonsense that's been going on with, be it, supply chain disruptions or, inflation and labour shortages and all of that. And they've still been able to deliver, in some cases, just incredible earnings. But I think that record is coming to its end. And there are three factors within there. I think a slowing consumer has to happen. And yet, again, if you look at the juxtaposition or the dichotomy of economic data, we've had a slowing consumer and consumer sentiment in the US, yet we had absolutely record Black Friday, Cyber Monday sales over the Thanksgiving weekend. And I think, on digesting that, and we haven't obviously seen the retail sales figures for Christmas come through yet, but a lot of that was Christmas shopping that's brought forward because it was a 20-25% discount as opposed to this surge in spending. And whilst when you discount, you get market share, the margin on that is much, much less. So your profit margin is a lot thinner. And I think that notion of discounting and slower consumer spending will affect earnings. I think also, several of the big retailers have been finding themselves in an overstock position. Walmart being probably the best example, where the inventory is building up and it costs billions. It's not like they've got a couple of extra pallets of stuff. I mean, it's an enormous company and there's billions of dollars of revenue tied up in inventory. It's got to be stored, and if it can't be sold quickly and turned over, needs to be discounted, which again sort of crimps on margins. So I think overstocking is going to be a big issue for a lot of retailers, and I think they're probably two of the major issues. So that weaker consumer, overstocking would certainly be where I see some of the challenges come. And then obviously there are costs as well in terms of higher interest rates, higher energy prices, higher wages. All of those, higher rents in some instances, that's all got to come from somewhere, and I think that's going to weigh very, very heavily in terms of the earnings season, which starts mid this month.
So earnings downgrades and poor guidance we'd be expecting from most companies, particularly in the retail space.
Yeah, I think certainly disappointing earnings, and I think a more realistic set of guidance this year than last, where everyone was more optimistic, going, no, things are good. I think the reality of a slower economy / recession. Prudent corporate management is going to have you coming out of the confession booth going, it's pretty tough out there, cut us some slack here, our outlook's a lot softer, don't expect big things from us this year. And then if you're able to surprise at the upside, the reward is obviously there, versus the fatal mistake of keeping quiet and then surprising to the downside and seeing your stock price absolutely pummeled.
Yeah, it's a tough one, and there's a lot of variables out there.
I do, and I think that's arguably the biggest weakness, or the biggest risk to markets is that earnings downgrade. If we start to see that on a broad basis, I mean, you expect to see it in retail, but when you start to see it on a broader basis in the economy, that's a major issue for markets.
What about China in there, AB? I forgot to ask it as a topic worth discussing for next year. What do you think? Potential relaxation of their rules?
Well, I think the difficulty for China is that the prospect of COVID zero is it's just an unrealistic expectation, and so from a Eastern culture perspective, and I'm not well versed in this, but of what I know, and I'm sure a listener's going to correct me if I'm wrong here. Saving face is an enormously important attribute in Eastern culture, and the Chinese government's requirement to show a strong, decisive approach to policy is key. And so to come out and have a zero COVID policy, they go, actually, we're not going to do that anymore, is exactly what needs to happen, but in order for it to happen requires a bit of a 180 in terms of what's been communicated to the population, and that loss of face is a huge one for the government to have to deal with. So whilst they know it's probably the right thing to do, psychologically and politically, it's a pretty hard one to go, yeah, look, we're doing this now instead, and trying to save face. So I think relaxation of COVID policy there, as it happens, and I think it will happen, is a wild card for markets, insofar as if China reopens, that's good for everybody because we get back to business as usual. It takes a lot of pressure off of the US to be the shining beacon in the commercial world. Also think, from China's economy's perspective, a relaxation, if you've got 10 million people that have been locked in an apartment for 2 months and now allowed out and about, it's not going to make a lot of difference towards goods and other countries around the world that export to China, but I think it's going to have a material impact on Chinese service companies, food retailers. Luckin Coffee, there's one for you.
Blast from the past.
Yeah, there we go. I haven't spoken about them for a while, but those sorts of businesses that are really focused on services as people want to go out for dinner and consume things and do things they haven't been able to do for the last few months. So in that respect, I think that'll give the Chinese economy a little bit of a kick along. At the same time, I mean, there's a flip side to what's gone on in China, and that's the pressure it's put on many manufacturers that are based there, and the vulnerabilities of frailties of their supply chain, where if you look at Foxconn with Apple's production, for example, 70% of Apple's iPhones come from there, and they haven't been able to produce them on time, and it affects supply, which affects revenue, which then affects profitability and earnings. So it's a major problem, and I think part and parcel of all this is likely to be that continued shift outside of China, and a look outside of China, if you will, from Western companies for manufacturing bases.
Maybe I think we've pretty much covered all bases there. Excuse me. Any other variables that you'd like to mention, or is that pretty much hit the nail on the head?
Look, there are always going to be more. They're probably the big ones for people to consider in their investment outlook. If we see the world sliding into a slower economic growth, which is going to be quite divergent, I think, between the East and the West. There are going to be some major winners in there, and there are going to be some companies and sectors that really struggle. And I guess we'll talk to what's on our hit list for success versus what's on the hit list for struggling as we get into our recommendations and preferred sort of plays for this year.
Well, let's do that. As we said, we're going to do a two-part series. So this is our outlook as such. When we come back next week, let's do some strategy on this.
Look, happy to do that. And I think it's been one for the books. We always say, that's an incredible year to have in the rearview mirror. But just with the breadth, depth, and magnitude, we haven't even talked about a war in the Ukraine, for example, which is a major factor, and we haven't talked about the impact that could have on energy prices and grain prices, which it has. That's just another thing that we've seen this year, and it's almost bled into the background, horrific as it is, reflecting, as I say, the depth and breadth and magnitude of news flow that we've had to contend with in markets this year. So it's definitely one that I'm pretty happy to see in the rearview mirror, and rubbing my hands with anticipation at what we're going to do this year, and I guess that's what we'll speak to in our next podcast.
All right, well, there's our outlook, AB. I'm going to stop you there, and we'll resume next week for the strategy on all of this. Thank you very much.
Look forward to chatting then. There you go, guys. Make sure you give us a review and a rating, and make sure you share this podcast with anyone you may know that would benefit from the content that we've just described.